If you're watching markets right now and something feels off, trust that instinct. I'm seeing the same thing you're seeing, trillions of dollars whipping around in hours, metals getting slammed on paper, and yet underneath all that noise, something very different is happening. Stay with me, because what just happened in the gold and silver markets isn't random, it's not emotional, and it's not over. And once you see the pattern, you'll never unsee it. I'm going to show you exactly what's creating this divergence, why it matters to your positioning right now, and what happens when this kind of setup resolves. If you're watching this video, you're already ahead of 90% of people who think price action tells the whole story. It doesn't, not even close. Before I explain what's causing this divergence, let me slow you down for a second and teach you something most people never get. Markets don't move as one thing. They move in layers. You've got the headlines layer, the futures and options layer, and then you've got the physical, real-world flow of assets. Think of it like a store during a panic. The price tag on the shelf might say one thing, but if the shelves are empty, the real price is something else entirely. That disconnect matters because it tells you who's acting short-term and who's positioning for what comes next. When you see futures prices dropping hard, but physical premiums holding steady or even rising, that's not noise, that's signal. It's telling you that paper markets are being used for one purpose and physical markets are serving another. The traders playing with contracts are managing risk or chasing momentum. The buyers taking delivery are securing supply. Two completely different games happening at the same time, using the same asset, creating completely different outcomes. So what does that tell us? It tells us we need to watch both layers, not just the one flashing on our screens. Now here's what's actually happening. While Western markets are dumping precious metals through futures contracts, China is quietly doing the opposite. Official data shows the People's Bank of China added gold for 14 straight months through December 2025. 14, no pauses, no, we'll wait and see. That's not trading. That's policy. At the same time, silver inside China is refusing to break the way paper prices are. Why? Because physical demand hasn't gone away. Industrial users still need it. Retail buyers are still taking delivery. And starting January 1st, 2026, new export controls tightened supply even further. So when futures traders dump contracts in New York or London, that selling pressure doesn't magically create new silver bars in Shanghai. It just creates volatility. Here's the cascade. First, leveraged funds get forced out during market stress. Maybe it's margin calls, maybe it's redemptions, maybe it's risk management protocols kicking in. Doesn't matter. They're selling because they have to, not because they want to. Second, paper prices fall fast because liquidity disappears. When everyone's trying to exit the same door at once, the bid vanishes. You get these violent moves that look catastrophic on a chart, but don't reflect any change in underlying fundamentals. Third, physical buyers step in quietly because nothing about their need has changed. A solar panel manufacturer in China doesn't care that silver futures dropped 8% in 2 hours. They need silver to build panels. A central bank accumulating gold doesn't care about today's volatility. They're thinking in decades. And when those three things collide, you get a widening gap between what the screen says and what the metal actually costs to obtain. Now let me show you what most people are missing. This exact setup has a habit of resolving violently, and usually not in the direction that feels obvious during the crash. When paper sells off hard but physical demand stays firm, you're creating a spring. You're compressing potential energy. The question isn't if it releases. The question is when and how fast. I'm watching premiums on physical silver right now. I'm watching delivery times. I'm watching what dealers are actually charging versus what the futures screen says. Because that spread, that's where the truth lives. If that spread widens, while futures keep falling, you've got confirmation that this divergence is real, and it's building pressure. But here's the part that should make you pay attention. We're not just seeing this in silver. Gold's showing the same pattern. Platinum's showing elements of it. This isn't about one metal having a weird day. This is about a structural shift in how different players are using these markets. Western financial institutions are using futures for liquidity and leverage. Eastern central banks and industrial users are using physical for accumulation and supply security. Those two strategies can coexist for a while, but eventually, the physical reality reasserts itself. It always does. Zoom out for a second. This is the same playbook we saw in the early 2000s, when central banks stopped selling gold and quietly became buyers again. For years, Western banks had been selling reserves, keeping prices suppressed. Then the trend reversed, not with announcements, not with headlines, just steady, quiet accumulation. And what happened next? Gold went from around $250 an ounce to over $1,900 in the next decade. That wasn't speculation. That was a fundamental shift in central bank behavior. creating a structural bid that overwhelmed paper market selling. You saw it again after the 2008 crisis, when paper liquidations smashed prices but physical premiums exploded. I remember dealers completely sold out while futures were cratering. You could see silver at $16 on your screen and pay $22 to actually get a coin in your hand. That divergence didn't last forever. It resolved, and it resolved higher. Not immediately, not cleanly, but structurally. The physical market eventually dragged the paper market back to reality. And you saw it again in 2020, when futures went haywire while real metal vanished. March 2020, silver futures dropped below $12. Try finding any at that price. You couldn't. Premiums were $5, $6, $7 over spot. Delivery times stretched to weeks, then months. And within a year, silver was pushing $30. Every time physical demand stayed firm, while paper cracked, the resolution came later, and it came higher. When you look at the pattern, the selling is fast, emotional, and leveraged. The accumulation is slow, patient, and intentional. One group is reacting, the other group is positioning. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could China stop buying tomorrow? Sure. Could silver demand soften if global manufacturing rolls over harder? Absolutely. Could this divergence just be temporary noise that fades without any dramatic resolution? Maybe. And not every divergence resolves the same way or on the same timeline. The mistake is turning this into a conspiracy story. This isn't about secret plots or market manipulation in the Hollywood sense. It's about incentives. Central banks think in decades. They're managing currency risk and geopolitical positioning. Futures traders think in days. They're managing leverage and short-term performance. Your job isn't to guess motives, it's to watch behavior. Focus on what you can verify, not what you can argue about. Can you verify that China's been buying gold for 14 consecutive months? Yes. Can you verify that export controls tightened on January 1st? Yes. Can you verify that physical premiums are holding while futures sold off? Yes. Start there. Build your analysis on what's observable, not what's debatable. There are probably 3 types of people watching this right now. Some of you are nervous, you saw prices drop, and you're wondering if you missed something or did something wrong. You didn't. Volatility like this is designed to make you question yourself. It's designed to shake out weak hands and create uncertainty. If you bought physical metals because you understand their role as monetary assets and industrial necessities, nothing about this price action changes that thesis. Your time horizon matters more than today's futures close. Stay focused on why you're holding, not what the screen says hour to hour. Others of you are opportunistic. You're asking whether this kind of dislocation creates long-term opportunity, and historically that's exactly when it has. When paper markets panic and physical markets stay calm, that gap represents potential. Not guaranteed returns, not risk-free profits, but structural opportunity for those with patience and conviction. If you're thinking about adding to positions, this is the environment where that makes sense, assuming your risk tolerance and time horizon align. Don't chase, don't panic buy, but recognize what you're seeing. And some of you are just trying to learn. You don't want predictions, you want frameworks, you want to understand how these markets actually work so you can make your own decisions. That's the right approach. For all of you, the principle is the same. Watch who is forced to act and who is choosing to act. Forced actors reveal stress. Voluntary actors reveal conviction. When you see leveraged funds dumping because they have to meet margin calls, that's stress. When you see central banks accumulating month after month regardless of price, that's conviction. Both tell you something valuable, but they're telling you different things. So here's what I want you to answer in the comments. Are you watching physical premiums in your area? Are you seeing delivery delays? Are dealers near you raising prices even while futures are falling? I want to know what you're seeing on the ground because that's where the real story is, not on the futures screen, not in the headlines, in the actual flow of physical metal. Here's where I stand. I'm not chasing rallies and I'm not panic selling dumps. I'm watching signals. Let me tell you what I'm personally watching. First, I'm watching whether China's official gold accumulation actually pauses or continues. If they pause, that changes the narrative. If they accelerate, that confirms it. Second, I'm watching physical silver premiums relative to futures prices. If that spread keeps widening, we're seeing confirmation that this divergence is structural, not temporary. If it narrows, maybe this was just short-term noise. Third, I'm watching whether volatility compresses or expands from here. If we get another violent move down with even higher physical premiums, that's the spring compressing further. If volatility settles and premiums normalize, maybe the pressure releases gradually without a dramatic snapback. Based on my analysis, this move wasn't random, it was mechanical. Leveraged positions getting unwound, liquidity vanishing, forced selling creating downside momentum. But the fundamental picture hasn't changed. Industrial demand for silver remains strong. Central bank demand for gold remains strong. Supply constraints are tightening, not loosening. Export controls are restricting flow, not expanding it. Those fundamentals don't care about today's futures price. They're operating on a different timeline with different priorities. This is what creates the divergence. And if history rhymes, the quiet accumulation happening now will matter more than the noise you're seeing on your screen today. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Look at China's official reserve reports. Track physical premiums in real time. Watch delivery times. Build your own analysis based on observable facts, not opinions or predictions. That's how you develop conviction that withstands volatility like this. If you made it this far, you're thinking like an analyst, not a gambler. That mentality will serve you well. Most people react to price movement without understanding what's driving it. You're asking better questions. You're looking beneath the surface. Keep doing that. Share this with someone who needs to see it. Subscribe if you want more breakdowns like this where I'm showing you the mechanics, not just the headlines. Stay sharp out there. Think critically, verify the data yourself, and make decisions from understanding, not fear.